Good afternoon, everyone. My name's James Stephen. And hopefully I get the online. I don't forget all the people online. I'm a financial planner. I've been doing this for about 20 years, so I have been around a bit. I don't know if I look the same age, but I certainly have been. And I've done a few things along the journey as well. So it's not just financial planning. Originally started in. Okay, go. Originally, funny enough, I haven't told the accounting team, but I started in accounting when I first started in my financial services journey. I wasn't quite, as good as these guys think it is. So I joined financial planning, and I've done lectured at university for about 5 to 6 years. Monash Uni in financial planning. They got their financial planning course set up, and hosted a radio show. A local community station. Did that for about 7 years. That was good fun. But now it's all hands on deck, committed to the team at Aintree. Now, just before we get started, whenever you see these sort of presentations, there's always going to be a disclaimer. The legal team would know why, but in financial planning, we're not allowed to give personal advice without going through proper due diligence. So it can only be general information. As much as people want to quickly get some answers about something, it's very hard for us to do that legally. So we actually have to do a proper process before we give advice. So hence why we've got this disclaimer. So just take everything here and just understand it's not for everyone. Everyone's circumstances are different. Everybody is in a different stage of their financial journey. And as a result, this is just information only. So today we're going to look at, first up, we've gone through the introduction, so we'll have a little bit more, and then we'll move on to financial planning, how the whole process works, how we do things in financial planning, because not everyone understands financial planning. A lot of people think it's all just about investing. They come in and they come to see us purely for investing, whereas, there's a lot more to it, a fair bit more to financial planning. Then we're going to have a look at the markets at the moment, because people are always interested in, what's happening out there and where are the opportunities, what are the sort of how the portfolio is positioned. So I think that's also a good exercise for us to do. And hopefully we don't run out of time, because I've got quite a few slides here. So if I skip through a few, bear with me. I can always answer questions about that later on. So we're basically a full service financial planning firm. We work collaboratively with legal and accounting, which is very important because, as you'll see later on in my presentation, they all sort of integrate. So you can't be just doing one silo type of work and forgetting the other areas, because if you do that, you end up not having a complete solution. And a lot of people will go to one firm for financial planning, one for accounting, one for legal, and if people don't talk to each other, you're going to have a sort of a mishmash rather than a coordinated strategy. So that's why we believe this is the best approach. And pretty much, I suppose, in a nutshell, our job is to help people make smart decisions, and smart decisions to help you achieve what you want to do using all the tools available to us. When I say tools available to us, I'm talking about there's all the superannuation, there's investment, there's cash flow management. All of these tools are out there, and we want to make sure they're tailored to your circumstances. So as you can see there, we're looking at wealth creation, pre-retirement, retirement planning. We're looking to help people increase their income, decrease their expenses, and reduce tax. I mean, we don't specifically do that. We do that in conjunction with the accounting team, but obviously there's some overlap when it comes to taxation. This might seem very simple because it is. The financial planning, if you break it all down to, is like any planning journey. We got to understand where you are right now, and we spend a lot of time trying to understand that, because if we know where you are right now, it's going to be a hell of a lot easier to know, where our starting point, because it's a journey to get to where you want to get to, which is the outcomes that you are looking for specifically. So once we understand where you are right now, who you are, what's important to you, and then where you want to get to and what does that look like, then we can then build the plan to help you achieve that destination. But keep it simple is our strategy here. And of course, why do we do a plan? And we want to put people in control. Because if you know exactly where you are, you've got the focus and you've got the clarity to begin your journey. Because otherwise, what people do is they jump at the next shiny ball, the next hot thing that comes along, they'll jump at that because they haven't got a coordinated strategy. So, we feel like if you've got a plan in place, you can follow that methodically. Otherwise, it's just what the latest thing is. And people get sidetracked. Or the other option, which commonly happens, is people procrastinate. Because if you don't understand something and you're not sure what it means for you, you might put off making the decision, pop it in the too hard basket. Whereas if there's a plan, you just follow that plan. And the way I like to look at it is we've got above the line planning and below the line. So our very first part is where we look at why. What's the meaning to you as an individual? What are you trying to get out of this? Who you are? What are your values? What's important to you? Because if we can work out that, then it's a lot easier to align your values to your goals. And then below the line is the products. So a lot of people come in looking for superannuation or the investments, whereas that's a tool. That's a tool in our toolkit. That's not necessarily going to achieve what you want. We got to step above the line and understand you and your family and what's important to you, and then we can tailor our products and services to that. So that's the way we always look at it. So we will spend a lot of time above the line just because it's the meaning that really matters. Why are you doing anything? And an example of that is, we get people coming in, and if you just speak financial, just talk about it in pure financial terms. Yes, you want to retire at 65, you want to retire on $100,000 a year or 80,000, or whatever you want. But there's no meaning behind that. Like, why? Well, why do you want to do that? So we want to step back and understand what's important to you. And it might be an example I've got here is the client wants to spend as much time with their grandkids as possible. So that's what drives their meaning in their life. So if that's the case, then it's a lot easier for them to make the trade-offs that need to happen along the way. Because when it gets hard, we can bring the meaning back and say, okay, well, you wanted to spend more time with your grandkids. So if that's the case, perhaps we'll do an annual holiday, international holiday every second year rather than every year, because that will help get us closer to the goals. Or we're running a little bit behind. Do we need to be so conservative? Maybe we need to take a little bit more investment risk to get us to that objective. So, and it helps people when times get hard along the journey. If you can focus around what's important to someone, you'll find that it'll be a lot easier for them to make the sacrifices or trade-offs they need to make, as opposed to just this number on a piece of paper. So it's really important we get that meaning first up so we can link that meaning to their goals. And how we would go about that is we use financial modeling, as you can see here, to sort of put the numbers into real life for them. So in this case here, and I'm going to talk about this in a little bit later, but if we use lifetime cash flow modeling, we can then work with that person to help them make the decisions to achieve the time with the grandkids. So you can see here that they're going to run out of money. They're going to run out of money. The way they're going and the amount of money they want to spend, they're not going to be able to achieve it. So in that example, that's where I go back to what I said. We make our trade-offs. Every second year travel, take a little bit more risk. Perhaps maybe we don't retire at 65, maybe 66. Maybe we push it out a little bit, but we do what we need to do to help them get this part right. And that way, it's a lot easier for them to make those trade-offs. And then when we get below the line, it's about the technical side. Okay, technical side is where we start. What people normally associate with financial planning, it's the numbers. It's how do I save and invest in the future? How do I create a passive income? What structures do I use? All of those things are the hard sort of money questions. But they're the things that have to come later once we've achieved the meaning. But we will obviously do that because there's no point. It's not airy-fairy. I mean, we're not just here to, we're not life coaches. We're here to link the two, the money to the meaning. In terms of like a general service, how you would operate is you need to have a strategy is obviously the core, but not everybody wants strategy. Some people want wealth creation. Some people just want to investment manage. They've got a portfolio of money. They already know what they want, so they just want the money managed. So that would be your wealth side of things. So we look at it once we've spoken to someone, understood what they want, they could have all three, they could cherry pick one at a time. Whatever you want to focus on is what we'll bring the discussion to. So the strategy pillar, this is an important one for most people, because most people don't have this piece right and they want to jump to the other bits. And if you're jumping to the other bits, like the wealth, what's going to happen is you're going to miss out on all the other opportunities that could help you accelerate your wealth or manage your wealth better. But I suppose when we talked about collaborating with the other experts, you can see we got tax in the middle. They all link to tax. Ultimately, tax is a component of all of them. So that's why we would work closely with your accounting team, just to make sure that it's all in line with what we're trying to achieve. That's why I said there's no point in having that siloed effect where it happens in absence of the other professionals. But in terms of a strategy, typically we would look at cash flow and debt management, insurance and estate planning, pension, social security, investment, super, and of course gold retirement and retirement funding. Now, an example of the type of things here, I've just popped it down. What might an optimized strategy look like? So you can see here I've broken down all the components and just given a little bit of information to that. So if you were sort of trending well with these answers, then you're ticking all the boxes. Now, obviously, we as planners don't spend a lot of time in this space because it's not really our thing. But obviously, these are the things we want to make sure you're up to date with. Some examples here with the cash flow and debt management, we typically would, when people are trying to manage their cash flow and trying to build wealth, we typically will work on a 70-20-10 process. So that's 70% of your money is living expenses, 20% on debt repayment, and 10% on investing. And then once all the debt's been paid off, or the bad debt, then the 20% that was used for debt repayment can then go to the 10. So at least making sure there's a balance between living for today and building for the future. So that's where the 70-20-10 would go into the cash flow and debt management. Another area might be the pension and social security. Now, there's a lot of different strategies there that people can use to build their wealth. And if structured correctly, you'll find that there are some rules they can really take advantage of, like Centrelink is a good example. When you have a younger person in a couple, what can happen is if you have most of the assets in the younger person's name, when the older person retires, they can get access to the age pension, because the younger spouse's superannuation benefits are not counted for the age pension test. So we've used that successfully for quite a lot of clients in the past, where you might have someone with a gap, like say 7 years is the latest one we did it with. So in that case, the funds were moved to the younger person's superannuation account, and the older person didn't have any assets in their name. So they were able to claim the full pension, even though most of the assets were in the younger person's superannuation account. Things like that can be done with a proper structuring. So it's just a case of going through someone's unique situation and then piecing all these pieces of the strategy puzzle together to get the best possible outcome. If you do that, you'll find your financial situation would obviously look a lot better than if you focus on one or two little pieces of the puzzle. So we go back to this modeling. So this modeling is something that I've done with clients for years. It's lifetime cash flow modeling. So what we do is, when we're building their financial plan for them, we actually want to see what the outcomes of the strategies are going to be. So how's it going to look for you? So on the first cut, for some people, maybe they want to retire too early, or they want too much money to spend in retirement, and it's not going to run out. So in this case, this person here is going to run out pretty early, before they turn 80, probably the late 70s. And then for them, that might not be good enough. For most people, one. I mean, I do have one client. This is unique, and it's probably not going to happen for most clients, but her financial plan includes going to Switzerland for the assisted suicide. I know that's weird, but in her family, no one's really made it past a certain date, and she's seen people not they don't have really good sort of genetics. So she just wants her money to last to 80 and then have enough to get over to Switzerland. So in her case, that's not a big deal. Okay. So I know that that's a unique situation, but for most people, they don't want to see that. Most people, what they want to do is they want to see something along the lines of this, but the next slide is actually the more appropriate one. So what we're doing here is with clients is we're trying to make sure that with their goals and objectives, no matter what happens, it's not going. They're not going to run out of money, because that's the thing that most people are most concerned about. So in our plan, we would say, okay, you want to retire. You've got this amount of money. This is how much you can save. This is how much you want to retire on. This is when you want to retire. So we put all that into the model, and the first case didn't work. So we're going to have to make some changes, and that's where we spoke about trade-offs before. So in that case, the trade-offs here have been made, or maybe this person has just done well and it doesn't matter, that their asset's going to keep going. But in this case, we might have a chat to them and say, well, look, you're definitely not going to run out of money. There's no chance of that. You've got way too much. Maybe you should spend some more. Maybe you should take a little less risk with your investments, because we get a lot of people coming in who just don't know how much they need to retire on. Everybody's sort of got an idea. You read in the papers, you need 2 million, 1 million. Who knows? It depends on someone's situation. I've made plans work for people with 300,000. So it's certainly not one size fits all. But in this case, and quite often people are worried unnecessarily that they're going to run out of money. And we show them and reassure them with the modeling exercise that no, you're not. You're actually going to keep building wealth. You're spending less than you earn even in retirement. You're going to leave a massive inheritance for someone. And maybe, they might want to leave a bit, but not at the exclusion of enjoying their lives. So we might want something along the lines of this, where it doesn't run out, and they've got a little bit of a sort of a buffer, so they're not going to sort of die poor, as they often say, but they're going to have some fun along the way. And that's the mix we're trying to get. But I think if you do lifetime cash flow modeling, it helps people guide them with their decisions. So it just means when they make a decision, they can make it confidently. They don't have to worry things are going to go wrong. And with people, at the regular meetings that we have annually, we would update it all, so we can constantly see whether they're on track or not. And if they're not on track, or the markets have changed, or something's happened, we can tweak it that year and get it back on track. So it's a very powerful tool, and probably the thing people like the most, to be honest, out of the financial planning. So that's pillar one. So it's getting our strategy right, getting everything done properly. Pillar two is our wealth building. So when we look at wealth building, there's different bits to it, but a lot of these things are standard core principles. They're not. None of this is sort of revolutionary. It's all stuff that's stood the test of time, and that's what you want to use. You want to use the ideas that actually work. So in terms of your goals, you want them to be clear and appropriate. I mean, they need to, as I say, smart goals. They need to be goals that are achievable. They're in line with your values, what makes sense to you, what is meaningful to you. Once we've got that in place, then we look at a balance. And when we look at a balance, that's the diversification piece. That's where you don't want to put all your eggs in one basket. Because we've seen repeatedly with the financial markets, things might be great one year, but the next year they're not. 1 year tech stocks is all the rage, and then the next year we have a tech crash, or we have COVID come along, or something comes along which throws that out of kilter. So the idea here is we want to have a balanced portfolio where we spread our risk all around. Maybe you're maybe you're an investor who likes a bit of risk. You want shares only, but it's not one or two companies. You're spreading the risk around a lot of companies, just to make sure that you don't have any one company bring down your whole financial plan. Costs, of course, that's another thing that matters. I mean, you don't want to, all things being equal, the lower cost option will work better than the higher cost option. But there's obviously reasons why sometimes people use higher cost options over lower cost ones, and it's to do with returns or a strategy they think might be better. But saying that, obviously you don't want to waste money. So where you can, you want to trim the fat, and that's where the minimised costs come in, and discipline, just to stay the course. And I'll go through some slides to show you where this pays off. So I've mentioned those guys here, but let's have a look at some charts. And this is where the perspective comes in. So this is the last, what are we looking at here? 30 odd years of financial markets. Now, some of these aren't exactly clear. They didn't translate that well across, but as you can see here, this section here is all the events that have happened globally. Now, you might not be able to read that, but that would be things like over here, you have the GFC, you'd have the tech crash over here, the 2000 tech crash. Anyone invested in that would know was painful. Then the GFC was painful as well. And then we had COVID. And then we've got the latest thing that's happening, the global supply chains getting destroyed or sort of influenced by the outcomes of the next stage of COVID, plus the Ukraine war. So they're all in there, but that doesn't stop the markets marching on. They keep doing their thing. They don't really care what the events are. They don't care who the leaders of the countries are. It doesn't matter. The markets just keep going. And obviously, different asset classes over here do different things. And you want to take a bit more risk. Obviously, when times are tough, you're going to feel the pain. But long term, it's those higher risk assets like the shares and the property that do the best. The cash and the bonds, they're going to do the worst because technically, there's no real growth in them. They're not designed. They're not there to grow your assets. They're there to provide an income stream. Now, uniquely in this cycle, the fixed interests component of people's portfolios fell very heavily in the last 3 or 4 months. If you've got any bonds or government bonds or corporate bonds in your portfolios, you would have noticed just how painful that has been. In fact, I believe it hasn't happened for 40 years where you've had the fixed interest falling at the same time as the shares falling, which created a horrible circumstance for retirees, because retirees typically, that's their portfolio. They've been told that's a safe part of your portfolio, and didn't pan out that way this time. And in fact, I was looking at it just the other day with a client. High growth investors over the last financial year actually outperformed conservative investors. Obviously, they all didn't perform very well, but it's not normally like that. So that's a long-term perspective of the markets. And also just bringing that back to another layer. These are the different asset classes. So you got your Aussie shares, international hedged, and then it moves along that way. Now, what it shows you here is the where you've got the blue marker here. That's where those assets perform the best in the year out of all the assets. Where you've got the orange one, it's the worst performing asset out of all of them for the year. But the one thing you notice if you look at that is it's very hard to say who's going to be the best. They all change. They all have their day in the sun. And in fact, quite often what happens is when one asset class does well for quite a while, typically does very poorly later on. So if you look at the US shares, they were going gangbusters before the tech wreck up here. They were quite often in the best performers. And then pretty much after the tech wreck all the way to the financial crisis, they weren't in there at all. Whereas Aussie shares too, I mean, we've probably noticed that with some of your returns over the last decade or so. But since the GFC, Australian shares have not been in the top performing asset class at all the whole time. So that's a sort of case for diversification, because you don't really know which one's going to be the king or the queen for the year. But if you've got a bit of everything, you're going to get some winners in there. And we'll just bring that back to this is the market cycles over the years. And what you can see there is it takes when you've got a bull market or a market where there's the shares and the growth assets are going up over the long term, they go for a long time. These are long cycles. I mean, not that long, but that's the shortest one is 5.5. You can see they go for many years, quite often a decade. And then when they fall, it's quick and nasty. Not long. You can see that, just short, sharp falls, but they're painful. So the secret there, and this is one of the things where as advisors, our job is to help people manage their emotions. And with their emotions, what I mean is at this point here, people want to get out. People say, look, if we just sat out for a bit, we'll come back in. We just don't want to be in there at the moment. It's too risky. We feel it's too risky. So let's wait it out. And over the past, I've seen people do that. And the problem with that is you miss this bit. Because as soon as you decide to wait it out and you sell down, you relax and stop looking at it for a while. And then by the time you've noticed it, we're already up here. And this is just an example here of reacting. So emotional management is one of our sort of probably biggest tasks of all. And you see, if you look at this is an example of just the ASX over a period of time, but jumping out of the market cost people dearly. So over here, if you just missed the 25 best days in 17 years, the returns are radically different. You might as well have just had your money in cash. So that's an important part of the role is emotional management, because it happens every time. Every time it's like, if we just get out of bed, we reduce the risk, I'll feel a bit better, I can sleep better at night. But we just got to hang in there for those short, sharp ones. And that's why getting your asset allocation right at the start is important. What do you feel most comfortable with? Because everybody feels comfortable with shares and property whilst things are going great. It's when the market collapses or falls, that's when the confidence is shattered. But you only find that out later. You can show them all the charts you want. Oh yeah, but they'll go, yep, I'll be right. Then it happens, and they're not. So we've got to get that part right first. But if we are in it, we can't get out until the worm turns. And I suppose this is just the final piece of the puzzle on that is the regular investment. People talk about dollar cost averaging, just repeatedly putting money into the market over this period of time. The regular contributions obviously is going to add a huge amount to your wealth. You can see here, these times are actually some of the best times to invest. It's like going to the shop and you have stuff on sale. Is it better to buy it at half price or full price? And when it comes to investing, people don't feel like that. It's obvious you should buy things cheaper, but they don't. So that's the outcome of someone hanging in there. Just keep the plan, keep focusing on the long term, which is this guy here. It's just building your wealth steadily as she goes. And when these times come, I think just delete your apps on your phone if you've got like your trading accounts. Don't watch the news, because their job is to scare you. That's what they do. I mean, it's non-stop. So it's pretty painful. This is just some other components, but when it comes to investing and setting up investments, we have to look at when we're structuring people up should they be investing in super or non-super, traditional super funds or self-managed super funds? You can go direct, or you can use a managed fund. Ethical funds is strongly in favour now and going forward for a lot of people. There historically has been a perception that ethical funds underperform the traditional ones, and people think, I don't want to have worse returns because I'm doing the right thing, but it's not the case. It really just depends on the cycle. So if commodity prices are high, then typically the standard ones will do okay. But when they fall, then the ethicals do well because they're more heavily into tech and healthcare type and industrial. So it does depend on the cycle. Obviously, you can have commodities. People will sometimes put gold bullion in their self-managed super funds just as an insurance policy. So we can bring in specific things as well. Direct property trusts. So there's a lot of good property funds out there where you can invest directly in like healthcare, which is always sells out. But healthcare is where you've just got medical professionals in a building, leased out for 5+ years, and they're obviously good for it at the moment. We know that it's an aging population and healthcare is not going away. So those type of sort of tilts for a portfolio can work nicely. And then you've got mortgage trusts as well, which is a different flavour, but it's another way for people to diversify their portfolio further. And then we've got the sort of third pillars, your estate planning and risk protection or insurance. Estate planning, well, this is the lawyers in the room, that's their area of expertise. But I suppose it's just making sure, the right money goes to the right people at the right time. I think that's the way to look at it. And to do that, you obviously got to line up your plan with the right legal documents to make sure it works well. Because what a lot of people don't understand is things like their superannuation doesn't necessarily get dealt with by their will, or insurance policies, or family trusts. So the idea is to work with the estate planning lawyers to make sure that all of your structures and all of your different components of your wealth plan all point to the right place. So if you don't want your assets to go to your estate, well, you want to make sure that happens. So you want to keep certain people out of it. You want to make sure that happens by lining it all up. An example of that is like just superannuation. People can nominate a person, just nominate them, binding nomination, and it goes straight to that person if they tick a few boxes, of course, versus going through the will. Or insurance policy, you can just name someone and it avoids the will. So it depends on what you're trying to achieve. And also over here down the bottom, with your will, you can put into place like it's called a testamentary trust, just to make sure that the assets don't get wasted by your beneficiaries. So you might have some children who have maybe got an issue with spending. They might have a sort of a substance abuse problem. They might have relationship problems. At least if you can put it all in place, so you can protect the wealth for them on their behalf. And then we've got the insurance, which provides the funding. So in the absence of assets, insurance policies will provide funding to your estate or to you personally. Depends on your situation. If you're retired, probably not a big deal. But if you're sort of in that peak phase of your life where you've got a mortgage, you've got younger kids, there's a lot of expenses going on then. And if anything happens to one of the key breadwinners or carers, it's a major problem for the family. So this is what insurance policies typically do. They just keep the lights on and the show going. And obviously the idea really is to make sure you're building your wealth along the way so that you need less and less of it as you get older. So that's really insurance's sort of role, to provide an asset where there wasn't one before. The different types of insurance, I'm not going to sort of drag it on, it can be a little bit dry, but you've got life insurance as if someone passes away. Total and permanent disability is if you can't work again, you get a lump sum. Trauma insurance, this one's probably not well known, but that's if someone has a critical illness. So it could be like heart attack, cancer, stroke, that make up about 90% of all those claims. I think I read a stat somewhere about 3% of people have those policies. I'm not sure if that's 100% correct, but they're not commonly owned, but they're ones that probably pay out the most with these two, with income protection. Income protection just replaces your salary if you can't work along the way. So those are the four main classes. And then if there's any sort of business owners here, you often hear terms about key person insurance or buy-sell insurance. These type of insurances effectively use the same policies, the life and the TPD and the critical illness. It's the same thing, but for a different purpose. So in their case, you'd look at the 3 C's. So you've got control of the business, and that's just to make sure if one of the owners passes away, there's funds available to pay out their estate, so that remaining partners can assume control of the business quickly. So it just protects the business from, you know, if there's things going on in a business, people like creditors or suppliers or customers might react differently if they think that business is in trouble. Whereas if the ownership is established quickly, that takes that out of the picture, and then cash flows a lump sum onto the balance sheet to be able to pay off debts, replace a key person. Those are the. So then you're in a situation where now you've assumed you can go and speak to your staff and your suppliers. I know this has happened, but I'm in control of the business. I've got money on the balance sheet. We're rock solid. And the thing that puts it all together, or particularly puts that one together, is this business will, often called a buy-sell agreement. It's just a legal document, which sorts out this ownership problem for you straight away. So that's your 3 C's of the business owners. This is just a little what that can do for you. Insurance. I think we know that, so we won't drag on that one. Let's hit the macro outlook. So we've gone through the planning side. Let's look at the investments. Let's look at the world as we said. So as you can read the heading, who is the most incompetent central bank of all? I don't know. There's a lot. You could make a really good case for RBA, our central bank. Not going to raise rates till 2024. I think everybody remembers that. I think we've still got a couple of years to go, and they're already well into it. So the RBA haven't covered themselves in glory, but yeah, effectively, what it does mean though is the rates have gone up. That makes conditions tighter. If it costs more money, costs more on your borrowings, people are going to have to find things that they might have spent money on previously. They're not going to spend it on, because people will always put their debt repayments ahead of discretionary repayments. Well, not always, but most people tend to do that. So it's going to affect the earnings of companies as well. Companies with borrowings, particularly large borrowings, they're not going to make as much money, which is going to affect their price. We've also had, obviously, we still the legacy effects of COVID here with China. They locked down repeatedly, so that has an impact with the Ukraine war on the supply chains, because previously everything was going great. Everyone outsourced everything to China. Everything turned up on time. We had plenty of stock. Now we've got problems across the board, not only with getting the stock, but also our energy costs. Gas it's gone through the roof. Particularly now that Europe is a country that's continent that's struggling a lot with that. You know, if we look at the current market, we've got we'll look at the negatives first, and then we'll head into the positives. But it's obviously going to impact the weighing on the markets. As you've seen, the markets themselves are very unpredictable. And we use for active management clients, we use a company called Watershed, and their strong belief is that we're you know, the way things are going is we're stuck in a range. So it's going to go, every time it gets to the top of a range, market's going to fall again. So they're not going to just keep going up, because there's a lot of things they're uncertain about. So the markets at the moment are thinking to themselves, okay, historically the central banks have buckled every time we need their help, and then they drop the rates, and then the markets shoot up again. So that's what they're betting on. That's what they bet on with that market's going up recently. But now, as soon as there's any hint that inflation's not going to settle, and the central banks are going to have to man their posts, that it's going to have a major impact on the markets. We've seen them fall again recently. So it's going to be a bit like that. So our active management team at Watershed, they're working on the range principle. So what they're doing is when they get to the top of the range, the range they've identified, that's when they'll start selling down, starting to take some cash, waiting for the inevitable fall, and then picking up some assets cheaper. So that's the way they're assessing it, and so far it's worked pretty well. So the positives are earnings have held up well. There's a lot of money coming out of companies, buybacks, especially in the US. They use buybacks to increase the value of their shares. We've got special dividends here, and also there's still a legacy of COVID where people have saved a lot of money because they weren't spending a lot. So they've gone out spending. So you'll see people talk about, rates have gone up. All this is happening. Why is the restaurants packed and all these people going out and spending money? It's because they've still had a lot of money on their balance sheets available to spend. Whether that remains the case forever, I don't know. But at the moment, it is the case. And things are cheaper, especially if we look at, say, Australia. Our price to earnings ratio is 13, which is pretty cheap. I mean, historically, it's somewhere around 14 to 15, and it's good dividend yield. Up until a couple of years ago, it was about 18 2 years ago. So it's come down a fair bit. So it's actually reasonably attractive in terms of the valuations. The US, well, it's a little bit different. They're at 18.7, which is still high historically, but they were way higher than that around about 2020. So the question is, as the top of the slide says, is there enough? Has it come down enough, or is there more to come? At 18.7, you might think it is the case. So just sort of heading to the portfolio itself. So this is our sort of main active manager. We use the active managers for people who like the feeling that someone's got their hand on the wheel when they're driving along. The passive portfolios where that's where people invest in companies like Vanguard, but they don't try to predict the future. They just pretty much take an index and copy it. So there's you might have the ASX 200. They'll just copy that exactly in terms of the components and the weightings, and they won't try and second guess anything. So they'll keep their costs low. Companies like this will be ones who will top, like I mentioned with a range, they will try and predict the future on your behalf. Whether they do it well or not, that all the proof's in the pudding. But so far, as you can see, they've done pretty well. Their inception is since 2016. So they've been going at about 7 years now. So they tend to do pretty well with their approach. As I mentioned, just a light sort of touch on the end here. Do we running out of time? Sorry, trying to speed through this, a lot of slide. So they've made some changes in the portfolio. So what they do, interestingly enough, is where they feel like the Aussie shares or the US shares at the top of the range, they'll include a short fund. So a short fund is a fund that actually makes money when the markets fall, on top of, well, obviously, if the markets fall, you're losing money. But if you've got a short fund, that fund actually becomes more valuable when the markets fall. On the flip side, when the markets get to the bottom of the range, they use a leveraged fund. So it means it has extra benefits when the markets go up. So they play around with those two options to accelerate the returns, either at the top of the market on the way down or at the bottom on the way up. So as it says here, they expect the markets to be sort of pretty much stuck in a range for a while. So there's not going to be any particular change to the pattern we've been seeing for a while now. Just a sort of idea of exactly what goes into these type of portfolios. You've got your cash, you've got income securities, that's fixed interest, so that could be government bonds or it could be corporate bonds. Then you got your Australian shares, which would be large caps, like the large companies, and then you've got the emerging companies like JB Hi-Fi, that's the ones that the future stars. International, that's a US primarily, and then that's just the other countries. So I'll actually show you the breakdown so you can actually see what makes a bit more sense. So the Australian portfolio would be, this is the current holdings. A lot of the old favourites. There's nothing in here that's particularly controversial. I think everybody sees these, knows pretty much all of these names. That's the Australian large caps or large companies. So as you can see, their dividend yields in line with the overall market. Then the emerging leaders, these are the companies that job it is to add a little bit extra return to the portfolio. They're the future stars, if you will. So in here you can see there's most companies here people probably don't know. I would say there's be a lot you don't. I mean, you obviously know Channel 7 or Collins Food. They own a lot of fast food companies, like I think KFC and things like that. a lot of the franchises. Baby bunting, obviously, that's it. That's always, babies keep coming, so I think they'll always do reasonably well. So that's the smaller companies. This is the US or the international portfolio. So these are the companies that are actually owned in the portfolio. So whenever someone sort of buys into the watershed, that's specifically what they're getting. So they'll own those companies in their own name or their structure's name. Income, this will be a combination of the government bonds and the company corporate debt. So you can see there that's provides the income for the portfolio. So obviously if someone wants more income, they'll get more exposure to this component of the portfolio. And then this adds a bit more diversification. So this is global diversification. So they'll make sure that the overall portfolio itself has exposure around the world. And just this last one here is that this is to take advantage of trends. So if there's a particular trend in currency or commodity prices, these guys will latch onto that and try to ride it for all it's worth. Particularly useful when the markets fall. That's when they do their best. All right, so we I've rushed through as much as I could. I wasn't sure the exact time, but just the last thing here is just a process. Like people go, okay, well, what's financial planning? What do we do? How do we do it? So in a practical sense, the discovery phase here is this is where we try to really unpack what someone's trying to achieve, why it's meaningful to them, what's important to them, understanding their family, their business, just getting a real understanding of where they are now and where they want to get to. And this is step 2 is obviously once we've agreed that, they agreed that, and they're all happy with that, we will then go to present the advice. So we'll go away, build a plan, and then obviously check the plan off with them through the modelling side, and then also implement the plan as well. So obviously if they're happy with it and it's worked well, then we'll start the implementation. Chelsea?
We have a question from the online group. So yes. Brendan has asked, what are your thoughts on crypto as an asset class? And I will note that Shane does have a slide on that coming later, but if you want to give your thoughts.
Okay, so I actually I spoke to Shane about this today, and I said I was going to put just a line item in it with those other assets, and the reason I didn't put it in, so Brendan, I would have mentioned it, is because I feel like it's almost like a religion. People either love it or they hate it, and I didn't want to sort of stir up any controversy. But crypto itself, at the moment, it's very a new and emerging asset class. So the idea that anyone can say, look, this is a certainty, this is gonna take over the world, we don't know, because the only experience I can think of was the tech boom, when the technology companies started to form late 90s. There was huge interest in that space, but ultimately when it all washed through, there were some winners, few winners, and a lot of losers. And I think with crypto, that's the case. So yes, it could very well be viable, and it could be part of someone's portfolio, depending on their risk tolerance. This is where we look at their asset allocation, make sure we've got the right risk tolerance. So if they're a high growth investor, it's definitely not going to hurt if they're really interested in it. And that's why I go back to that unique for someone's circumstance and their tolerance. But they also have to understand right now it's extremely high risk. It could pay off, and if you're going to go down that path, probably better off sticking with some of the bigger names. So same principle, you'd use your Bitcoins or your Ethereums as your core of the portfolio, and then you might play around with some small caps as you will, hoping to shoot the lights out, because that's really what it is at the moment. It's people wanting to shoot the lights out. So Brendan, I'm sorry, I can't say definitively whether crypto is the future. Parts of it will be, no doubt. It's a digital world we're entering. It's a digital asset class. So yes, there'll definitely be parts, but as to who the winners and the losers are going to be, I certainly can't crystal ball that one for you. But it's viable. And just before this is the last slide, I think. So, and then the ongoing wealth management. So this is for people who want that want to work with a trusted advisor to make sure their plan is always up to date. So their financial house, so to speak, is in order. That means all the boxes are ticked, I's are dotted, T's crossed. And also they're on track to achieve their goals. So we showed those slides with the lifetime cash flow modelling. The idea there is when changes need to be made, we make them early and regularly, rather than waiting 10 years down the track and finding out, well, it's gone way off course. So that's the purpose of the ongoing management. And you can see a little drawing there is people have a plan. I don't think this is unique to financial planning. I think if you run a business or you've got any plan, that's what it looks like at the start, but that's actually the reality. Personal circumstances change, your life changes in terms of the legislation, the financial markets. It just a lot changes. So it's not going to look like the top one, it's more like the bottom one. And that's kind of what we're trying to do with our regular meetings, is sort of navigate along here. And when you have these sort of problems, particularly here, we've got the little cloud raining. That's probably like when the markets fall and we tell you, don't get out, hang in there. And if you can, put a little bit more in. So just a little last slide on the same principles. These are sort of things we would do with people. Just making sure that they're on track, just keeping them accountable, educating, helping them get organised, make sure everything's done properly, working with their experts. So whoever they want to engage to help them along the journey, we'll work with them. That's the Q&A. So if there's any questions for anyone? Sorry, I felt like I was racing through, but it was a lot of slides. Yes. Oh.
Okay. I'm just curious, and everyone's going to be different in their investment.
That's right.
With your clients, do most of your clients look at their retirement planning like an annuity, so that they've exhausted all their cash and assets by the end date, or because that's what the graph earlier suggested, or plan around trying to live off the cash flow from the asset base?
Yeah, so well, I mean, in an ideal scenario, if it would be you've got so many assets, or the asset value is so great that the passive income off the assets is more than enough for you, so you don't even have to touch the capital whilst still having a great standard of living. I mean, that's the holy grail of it. Most people don't get to that. So what we do in the planning is we always want to make sure there's enough, because it's a model, and model's only as good as the inputs. So you can model all you want, but it doesn't necessarily mean it's going to happen. So that's why we regularly want to update that model. But we also want to add a lot of sort of fat into the model. So we want to make sure that there's that at each point of the inputs, none of it's just priced to perfection, as they say. Because in the share market, if it's priced to perfection, it means if one thing goes wrong, you're going to lose money. It's going to fall. So we don't want that. We want to make sure each part of it, the investments they invest in, may be a little bit more conservative than perhaps they need to be, if they've got enough. Or maybe we work another year later, or we just want to make sure each input in that model means that they're almost certain to get there. That's the way I would prefer to do it for most people, because not everyone's going to turn up just completely cashed up so they can just live off their asset base forever. Out of the people you see, some people do.
And just on that too, yeah, like trying to work out if you've got $1 left at the end of it, that's too risky. Yeah.
I mean,
some of us old-fashioned types, like to leave something.
Yes.
Yeah, correct. So you need to obviously schedule around some assets.
Yeah, that's important. That's part of that is part of the unique part of the plan. There'd be some people, maybe the part of the inheritance goes a bit earlier. So the am I okay was where people looked that one chart where people were way above where they need to be. Maybe there's an inheritance early. Look, because quite often people need for housing.
Sorry, could you just repeat the question?
Oh, yes, I was supposed to do that.
So just like a summary of what you were ending.
Okay, so if I could get that correctly, when we do our modelling, are we modelling to run out of money at a particular date? So just to get it exactly perfect to the last dollar. or we prefer to be in a position where our asset base is just paying, we're just living off our earnings and not spending the capital. We're probably, for almost everyone's going to be somewhere between. It's going to be somewhere between. So, and also when I do my modelling, I want the model to work 10 years past life expectancy. So I'm not like, I wouldn't do a model to 83 years old if that was the average life expectancy, I think, of a female. I don't know the exact numbers nowadays. Well, females are ahead of the males in this one, Graham. Yeah, it's true. But yeah, I think it's about 83 for females, and males a bit younger. But we always want to add something to that. Otherwise how do you know? Well, you kind of know. You probably look at the family and go, okay, well, look, we're looking good. And there's some people who've got a lot of 100-year-olds in the family. So for them, we want to model past 100. Or yeah, that's the other option. If wheels fall off, you're going to Switzerland. We'll save $2,000 in there for the flight. I don't know what the actual process costs. So Chelsea, was that okay?
Yeah.
Yes.
When you're doing your modelling, superannuation,
yeah. Okay.
where are we at?
Good question. The question is, when we do our modelling, do we take into account the government policy, primarily for superannuation, but Centrelink as well would come heavily into that as well. We do, because we only work on what we know right now, because otherwise it's like planning for an inheritance. I often get people say, yeah, I'm expecting an inheritance, so can we pop that in there? I'm sort of thinking, can't pop that in there because might not happen. They might need it for something else. Something might go wrong. They might not even want to give you one. So we don't factor those sort of changes in. That's where the ongoing process works. So we'll redo the model. We keep the model up to date. So any changes, it's going to factor into the model. And the software we use factors in all the legislation at any one time, whether it be Centrelink, whether it be tax, whether it be superannuation, it's all factored in. So when those rules change, it changes.
Sorry, a bit of a technical issue. Keep going.
That's all right. Any more questions?
Yes, sir.
Direct property.
Yeah.
A lot of households obviously hold a lot, if not predominant wealth in direct property.
They do.
How do you treat direct property in relation?
Well, the actual primary residence is not part of it. Like it doesn't matter whether it's worth 5 million or 500,000, because we're looking at investable assets. But we do keep up our sleeve the fact that some people may, in their plan, want to downsize. So take advantage of those rules. We just want to make sure it's coherent, though, the strategy, because a lot of people want to downsize, but effectively they downsize from their house, which is a little bit, not everyone, but like maybe a bit run down, to a flash apartment or townhouse. They don't actually get any savings. Sometimes. I'm just saying, so we want to make sure they're clear on that. Obviously, if the house is worth 5 million and the apartment's worth $1 million, there's going to be some money left over. So direct property, definitely part of it. But if it's your primary residence, we've just got to be careful with that one. We can, as part of Centrelink does have various options to allow you to utilize your property later on for a reverse mortgage or something like that. So that's our before Switzerland plan. So we run out, we've got the property, we can then tap into the reverse mortgage through Centrelink to top up their pension so they can get by for the rest of the journey. The only unknown right now, I think, with property, that's why I'm extra careful, is aged care and the rules. Okay, right now it's okay, but the rules keep changing, and when the budgets are, when they're looking for money in the budget, these are sort of areas they're going to look at. Centrelink, who gets access to age pension, treating your family residents for pension also, because right now it's excluded. So direct property is one we bear in mind, but we don't plan, like an inheritance really, unless it's right here, right now, we're selling, we're going to get extra amount. So that's how I'd look at it. Graham.
James, as a business advisor, I get the question all the time, a client says, how much do I need to retire? You touched on it earlier on. And I think most conservative individuals live in their means. And, I generally say to clients, whatever you're earning leading up to retirement, if you're living within your means, if that number is 10 grand a month, you should try and aim towards having 10 grand a month or a pension of some sort of income. The government's come up with this number of $1.7 million, which is pretty hard for a lot of people.
Yes, it is.
To reach. But is that a general, my theory is if you're living off 10 grand a month and you're paying all your bills and you pay down all your debts, and you should try and aim towards that. It's easier to reduce it rather than increase it.
That's true.
What are your thoughts?
Okay, great question, Graham. So the question for the online people is, firstly, what's the correct approach to deal with the income you need in retirement? What number should we use? And Graham offered up his idea that what you're living on now is probably a good proxy for what you'll need to live on later. So I'll answer that, but I'll start just quickly with a bit before that. There's a Westpac and the Association of Retirement Funds or Superannuation in Australia, they prepare a quarterly budget for retirement. So every quarter, they've been doing this for many, many years, where they look at all the type of costs you'd need to have for the average person to have a comfortable retirement or a basic retirement. So they literally put together the budget. It includes everything like going out, travel, things like that. And they increase it each quarter because of inflation. It's currently, I don't know the specific numbers this quarter, but it's somewhere around about 63,000 per annum for a couple. Comfortable retirement, basic retirement's more like 40 odd for a couple. So that's the starting point. So I'll often, because some people just don't know. And it depends where you are in your life stage, because if you're close to retirement, you already paid down all your debts and your kids are educated and you've done all the stuff that you plan to do, then your monthly spending is probably about right, because it's not going to change when you retire. The tricky bit is for people who are way off, where they've got all the debts, they've got the kids, they've got a lot of things that still haven't happened yet in their plan. So we can't be 100% sure. That's why I use the proxy of the budget to start off with. So I'll get a feeling from just looking at their cash flows. Are they spenders or savers? And I think if you're a saver, you're probably okay. If you're a saver, in fact, you are okay. Every model I've ever done, savers are fine. It's the spenders that are the challenge. So yeah, I've got people who save money on the pension. Okay, there's not a lot of those clients because they're typically ones you wouldn't normally see, but there's one individual I'm thinking of. He lives in the country, not a big spender, doesn't have any hobbies, so for him, not a big deal. But for most people, they're not saving on the pension. So yeah, it does come down to where you are. But yes, if you get right to the end, you're probably not going to change your spending. If you're 63, going to retire 64, and you paid everything off, you're going to probably spend the same. But it is a bit of work that.
James, I'm just wondering, to what extent do your clients bring their families in?
Okay, so the question was, to what extent do our clients bring their families into the conversation with us? It does depend. It depends a lot on the individual, but we try to actually piece that together when we do our client questionnaire or discovery process, that first step, because it can have a major impact. Like, people will leave things out which are very important. Like you got childcare support. You've got like someone who's relying on you. In like, maybe there's a disabled family member, or they're paying for they're expected to pay for parents. There's quite a lot of people that I deal with. So like, if they're from India, they're expected to pony up for mum and dad. So that's part of the plan, is they've got to be sending money over.
So I should clarify that. It's to upskill them so that they are better equipped to be able to make their own decisions as part of an ongoing family wealth strategy.
For their other family members or the
kids, adult kids.
Oh, okay. Yeah. Well, it depends on the client, because some clients are reluctant to involve other family members. I think if they're embracing it and they're interested, the kids, it's a good opportunity to bring them in, because what we can do is we can start them off on sort of like a low cost operation for them, where they can just get general sort of basic advice, but they can make the right decision. So later on, they're in a good position. So we can give them that education piece around, which I have. I've got some clients who their parents will refer and they say, what can you do for them? And they're not normally a classic client. They're not in a position to be able to afford the fees or have the assets in place right now. But if we can give them the right guidance and just some basic steps to follow, they can then build their wealth and be in a position to be clients later on. So we do work with them for that purpose, because it makes the families, the parents plan better as well. Because if the kids are doing well, the parents have less obligations later on. So it actually works well if you can educate the kids as early as possible.
I can say that can help the family wealth
Yeah.
creation strategy, long-term, intergenerational.
Yeah, makes a huge difference. If you can get them, if you can get the younger kids skilled up fast, help them avoid making silly decisions, which is, well, it happens.
Particularly when they're going to get an inheritance.
Yes.
Yeah.
Well, that's a challenge. Once they know that.
No, but it can work the other way.
Yeah.
Bring the team on together.
Yeah. I've just seen a lot of cases where once they get in the inheritance, the foot goes off the accelerator, and it's just they just relax into their inheritance.
The stats, if I may, the stats are that 1 in 3 families get it right. They keep going for several generations because they've got it right, and the other 2 miss out and they waste it.
Yeah, no, I think it's really important. If you're doing a wealth plan, you have to look at the overall family tree, because if you don't, you're going to miss a lot, and you could affect their plan without even really meaning to. So yeah, thanks for that, Peter. Great question.
Question. I think maybe on the back of that, at what age or what life stage would you recommend clients to come in financially planning for retirement? Even like you said, it was an afterthought, or people procrastinate a lot. So what would you suggest for people?
So what age? The question was, at what age should you plan for retirement and start the ball rolling? I think it's challenging because there's a lot of living to be done before retirement. So you could just say it's all about retirement and just really hammer away at that. You'll end up with a huge retirement, but you might get hit by a bus 64 and it's all over. So I think the balance we work with clients is trying to get that the current today as well as the future. So I think the first step is really being educated about what the general process is of building wealth. Because retirement should be just seen as sort of like financial independence. That's what people prefer. A lot of people don't like planning for retirement when they're in their 30s. But if financial independence, where they can stop working and do some other things that make a lot of sort of meaning for them in their lives, they prefer to talk like that. So yeah, if they're educated and they understand the principles of getting their super set up properly, the right investment asset allocation in there, spending less than they earn, the 70, 20, 10, doing all those sort of things, it'll sort of get them on the right path. And then when the time comes, we can move into the super phase. I just feel like the rules around superannuation are uncertain and they change all the time. So yeah, you could, when you're 60 or 59, you go for it. Plan all you want about having every cent in there, because you can grab it by the next year. But if you're 20, I mean, really, do we know what super's going to look like?
I would say, just to add to that, education is key and starting early. So starting as early as you can, so you understand what's involved and what you need to do. Doesn't mean you've got to start, putting, as James said, putting all your money away in these things, but just understanding the concepts and everything to start with will then change your psyche, and that might help you in the long term and be able to retain and build wealth quicker than what you would if you leave it for 10 or 20 years. So
Same with estate planning.
absolutely.
Never too young.
Correct.
18.
Yes, correct. But yes, so the earlier the better. And we find a lot with the younger generation. I'm not trying to be offensive here, but they don't learn these life skills. This is a really important life skill to understand saving and investing and planning for your future. And so learning those life skills as soon as possible, I think, is invaluable. Yeah.
Spot on. Okay, so is that it, or you're eagerly waiting for Shane?
Is the pension always going to be around?
I believe so, but I believe in different. It'll be done in a way because currently we use the means test. Oh, so apologies. Will the pension always be around? We're talking about the Centrelink pension. So currently they use a means test. Well, they have for many years, and the means test just pretty much makes sure that if you've got too many assets or too much income, you can't get it. So it keeps it affordable for the country. However, as the budgets get stretched further and further, I believe what they'll do is they'll just tweak the means test. They'll make it harder. Or they might make people start to add their property into their overall asset base for the purposes of the means test. So there's a lot of things they could do to keep it going for a long time. So you could end up in, or potentially they reduce the sort of CPI indexation they use. So maybe it's not worth much. Maybe you get it, and they can always say you get the pension, but maybe the buying power of that pension down the track's not great.
Almost a safety.
And that's what it always was. I feel like at the moment it's a bit of a honeypot versus a safety net, because there's a lot of levers you can do to get people Centrelink. I mean, it's very generous. In fact, right now you can apply and get the Commonwealth Seniors Healthcare Card, which allows you access to the pharmaceutical benefit scheme, which basically means cheap medicine and prescriptions. It allows you utility bill savings. It allows you public transport savings. As a couple, you could earn $92,000 in income in retirement and still get it. That's more than the average wage. So you can get that in retirement, all those benefits still now. So if that system's sustainable, maybe, but probably not. So I think changes will happen, but I do believe the actual pension as it is will still be there, because politically, who's going to get rid of the pension? You can make it so it's not worth much, but you can't get rid of it.
Right.
Yep.
Thank you.
Okay, so just following on from James's presentation, I'm just going to talk to you about the tax side of things regarding wealth building, and I'm not going to go into too much detail. It's mainly about looking at what the tax consequences of different classes of income is, so you've got a good perspective on that. So, and again, with James, I have to do a general disclaimer. So this is general advice only. It may not be relevant to your personal circumstances. If there's something you want to know about further for your own personal circumstances, then please see James, myself, or your advisor, and we can give you specific advice to your needs. So first of all, the boring stuff. So just going into tax rates. So this is the tax rates for the 2023 financial year for individuals. So tax-free up to 18,200, and then you've got the next bracket, which is the 19% bracket, and then right through to 180,000 and over is 45%. You've probably heard in the media recently about there was legislated tax changes were coming in the 2024 financial year, and whether the Labor government were going to honour those or not, and they've said that they will. That's going to change these tax rates. I'm not going to go into that today, but suffice to say that bottom bracket 180 plus will go to 200 plus, and then they're going to basically eliminate the brackets 32.5% and 37% and have one bracket which is 30% between 45,000 and 200. So it's going to be quite different. Someone on 200,000 a year will save about $8,200 in tax per year based on the tax changes. Someone on 45,000 will save $400 in tax. You can make of that what you want, but that's the situation. For companies, the general standard tax rate, and particularly for large companies, is 30%. But if you're a small business and you qualify under these certain criteria, small business entity, the tax rate is 25%. For the purpose of the exercise today, we're talking about investment income, which is coming from mainly listed companies, etc., where you got 30% tax rate, and that's what we're using as the examples for this. Superannuation, the tax rate is a flat 15%. However, personally, if you make contributions to a fund and your taxable income plus other adjustments is more than 250, then you pay 30% on those contributions. Just answering the question you said before about superannuation, what the likely changes are. I think they're all a bit shy to do much at the moment in terms of changes, but there was a stat that came out recently where the pension concessions that are currently operating, it's getting up to about 50 billion per year in concessions. They're going to have to do something with that So at the moment, you've got a transfer balance cap of 1.7 million, where your earnings for that portion of your fund is tax-free. Let's see what they're going to do in terms of any change to that down the track. But this is a growing problem, and so there will be changes, but who knows what they'll be and when they'll be as well. Let's wait for the Labor Party's bringing out a budget, I think, in October. We'll see what the true financial position is of the economy and the government, and then we'll see what comes from that. Okay, so just showing the different types of income and how they affect your taxable position. So looking at the investment returns, first of all, we're doing this on a flat line basis. So we're talking about dividends here, franked dividends, so fully franked. That means that the dividend you're receiving, say from BHP or whoever it might be, has been fully franked, meaning that the tax has been paid on it, and you get a 30% tax credit on that dividend. So I've done it individuals, so you'll see there's 0%, 19%, 32, 37, 45% brackets. That's based on the context of this slide here. And then we're assuming we're receiving a $100 dividend as cash received. So BHP's declared that dividend, we've received $100 cash based on our share. So if you're on a 0% tax rate, that was clever. So if you're in a 0% tax rate, the way it works from a tax point of view is you receive that $100 dividend. Then we have this imputation system where we have to gross that up for the tax credit that you're receiving on it. So when you get your dividend statement, it'll say, here's your dividend of $100 and here's your franking credit of $42.86. We need to add that to your taxable income. So your taxable income, even though you're only receiving $100, what you show on your tax return is $142.86. That applies no matter which tax bracket you're in. So you see that's consistent right through. The next part is we then apply your marginal tax rate. So if we're at 0% tax rate, there's no tax, obviously. 19%, etc., 45. So $64.29 would be the tax payable on that dividend of $100 if you're in the top marginal tax bracket. But then you get a credit for that franking credit, the $42.86. And that gets as a refund if you're on a lower tax rate than what that 30% tax rate is. So you can see on 0% tax, you get that all refunded back to you. So you get the full $42.86. So your not net after tax position has actually grown from $100 to $142.86. On the 19% bracket, your net return after tax rebates is 115. And as you can see, as your tax rate goes higher, that diminishes to go ultimately below $100 once your marginal tax rate, 32.5, is below that company tax rate of 30%. So you can see for low income earners, franked dividends are a very good strategy because it gives you a tax return on investment as well as the normal return on investment that dividend is providing you. So that's for fully franked dividends. For superannuation funds, the tax rate, if you're in accumulation phase, so that's where you haven't retired, the tax rate is 15%. So same process, going through all the same numbers. You get a rebate of half of the franking credit because it's at 30%, your tax rate is 15%. So you're getting $21 of that back. So your after-tax return, if you're in superannuation fund, is $121.43 on that original cash payment of $100 that you're receiving. So it grosses up your return by 20%. If you're in pension phase, so you've got that transfer balance out, your superannuation fund is below 1.7 million, you've retired, it converts the tax rate to zero. You'll get that full $42 franking credit back, which means your return on investment goes from $100 up to $142. So this is why superannuation is a very attractive vehicle from tax point of view, not only in accumulation phase, but also in pension phase, because you're getting a refund of credits that companies are paying you as dividends. So large corporates, BHP, CBA, NAB, whoever it might be, they're paying tax at 30%. They're then flowing that dividend through to you, and then you're getting back some of the tax that they've paid. So the government is returning to you some of the tax that those big corporates have paid because you're in a low tax environment. The numbers on this one, I can't remember what they are, but they're quite substantial too in terms of these refunds and what that has an impact on the revenue that the government is raising as well. So this is another one where there might be some changes down the track. I'm saying might, it's about political will, political suicide, whatever you want to call it, because Labor tried to do this 3 years ago in the last election and they came unstuck. So I think, again, it might be one of those things that's too hard and they might leave it alone. Trust distributions, so different. So again, you get an $100 distribution. Now I'm going to treat this one, I'm going to call this one a property trust distribution. So this might be where you're in a listed property trust and they might have a building like this one that is part of their investments. Under those arrangements, they can get these lovely depreciation deductions, which means the amount that you're receiving can have what's called tax deferred components in it, where they're getting accelerated depreciation or other tax related benefits, which means that we don't have to show the full distribution as taxable income. So let's say in this case, we've got a tax deferred component, which is 80%. So what it means is you receive a $100 cash distribution, but the taxable value is only $20 because the $80 is deferred. What I mean by that is it reduces the cost base of your investment. So let's say you paid $10,000 for that investment. When you receive this $100 distribution, $80 that reduces that cost base for capital gains tax purpose going forward. So instead of it being a $10,000 cost base for when you sell for capital gains tax purposes, it will now be $9,920 because we've got to apply that $80 deferred amount off the cost base of the asset. So I've just factored that into this to see what the result would be if we had that situation. So we have a tax position if you're on 0% tax rate, have a tax position of $20, no tax on that. We don't get a rebate or anything for that tax deferred component. It's just not treated in any way for tax purpose in this scenario. So if you're on 0% tax rate, you basically overall cash position is $100 because you're getting no tax rebates or not paying tax on that distribution. Under a 19% tax bracket, you're losing $3.80 in tax on that. So your net cash position just on the distribution alone is $96.20. But then you have to reduce the cost base of that asset. So we're saying if you sold that in the future, there'll be a deferred tax consequence of a capital gain of $40. Then we apply your tax rate to that if the tax rate's the same at the time. Now we don't know, but long and the short of it is, with all these wonderful ins and outs and ups and downs and everything, the ultimate return on that investment would be $88.60 on that $100 dividend that you receive, because we've got to factor in the capital gains tax consequences down the track. And as your tax rate gets higher, you can see that diminishes and diminishes. So then if you compare that to what the dividends look like, that's where when we're looking at the tax consequences of investments, the actual tax components of that is fairly important in terms of looking at the overall return. So dividends, franked dividends might give you a better return than what it might be through a property trust or anything like that.
Jane, how do you know what the tax deferred income percentage?
They will show that on the actual tax statement. So you get a tax statement every year and they'll say this is a tax deferred component.
And what is it normally?
It depends on their circumstances. So if it's new property, they get lots of depreciation deductions, which brings it down. If it's an older style property, it might be less. So it really depends on the life cycle of the investment. There's no hard and fast rule. Yeah. So that
just on that side, each year you've got to do this calculation.
You do, yeah.
You do this annual adjustment on the third portion. You've got your investment for 10 years, 10 calculations work out for you.
That's what we gave you to do. Yeah.
Oh, sorry. I've now forgotten so the question was, with the tax deferred component, is that a set amount or is it vary between? How do we know what it is? We don't know what it is. It depends on the investment, as I said, and yeah, we get a tax statement each year which advises that. And then Graham just came in and said that yes, we also need to adjust the cost base and calculate that every year for that deferred amount, so that when the client, when someone does sell that investment, we've got all that information at hand so we can do the proper calculation. A lot of people miss it. It's also for rental properties, digressing for a minute. Rental properties where you get the depreciation or what they call the building write-off allowance, same thing applies. People think, oh, I'm getting this wonderful tax deduction for depreciation on this property. That's great, you do, but then that reduces the cost base of the asset. So when you sell, you're going to pay more in capital gains tax at the end. So if you've claimed $200,000 worth of deductions over a number of years, then you've got to basically reduce the cost base by that $200,000 worth of deduction you've had. So yeah, so there's some stings in the tail. It's deferral, and there might be some benefits there because you get the 50% capital gains tax discount. But yeah, it's still, there's always a sting in the tail. And again, another little Shane McKenna commentary, which could be completely wrong. That's another thing that I'll look at again, is 50% discount, whether that's appropriate or not, because there's a lot of revenue being lost in that respect too. And if they're trying to do budget repair, these are all the things that I'll target. But again, Labor tried all of these things 3 years ago, and we're completely they didn't win the election, so I think they're going to be very cautious or shy to do anything dramatic in the near term. Same thing with superannuation funds. It's different here because superannuation funds don't get a 50% discount; they get only 1/3 discount, but their tax rate is lower. I'm not going to go into all this, but again, you've got to look at the issues. So what I'm trying to get to here is every type of structure you have. So whether you've got a super fund, whether it's an individual, and also the type of income, whether it's dividends, whether it's interest, which I'm coming to now, crypto, which we'll come to in a sec. All the circumstances are different, defining the class of income and the type of structure you have. and that all has to come into the financial plan that we do, and they're all relevant considerations. So with interest income, there's no tax withheld or franking credits on interest income and other types of income, such as net rental income. You can see it's pretty clear here. You're losing your tax rate. So your $100 originally that you get returned, if you've got no tax rate, if you've got a zero tax rate, you get 100 back, and then sliding scale, it's just basically the $100 minus your effective tax rate. So if you're earning interest income and you're on the 45% tax bracket, 180 plus, you're gonna lose 45 cents in the dollar in that income, right? So you're gonna be left with 55. So then the investment power of that return on investment is diminished because you're paying more tax on it and then having less after tax to then reinvest if that's what you're trying to do. And same with superannuation funds. So if you're in accumulation, just lose the 15%, and if you're in pension, the amount is zero. Crypto. The ATO is having a field day, is all I can say. And in fact, when we do clients' tax returns now, it'll actually show if they've been dealing in cryptocurrency, it'll actually say the ATO will report, we are aware that you've been trading in crypto this year. Please make sure you put into your tax return the amount of crypto income or loss that you've got. Now, that's the first part. The second part is actually understanding what the tax consequences are on crypto, because most people do not have a clue, because they think I've got a crypto wallet, and as long as I keep it in my crypto wallet, I've got no tax to pay. That is completely wrong. So the way it works is that crypto is deemed to be an asset for capital gains tax purposes. It's not just like cash. So, you move cash from one account to another or wherever it might go, there's no tax consequences, but with crypto, it's completely different. So most activities involving crypto assets amount to a transaction that's subject to capital gains tax, and that could include any of the following. I've got them here. Selling a crypto asset, gifting a crypto asset, and that could include NFTs, non-fungible tokens. Trade, exchange, or swap a crypto asset for another one. So if you move from Ethereum to Bitcoin, or whatever it might be, or Dogecoin, the transfer from, even though it's in your one wallet, the transfer from one to another is a deemed disposal of that first one and an acquisition of the next one. So if you paid for that original, let's say it was Ethereum to start with, and you paid $2 for Ethereum and went up to 10, and then you move that $10 across to Bitcoin, then that $8 gap is taxable. Even though it's staying in your wallet and you might not have converted that to cash. Doesn't matter, because you're moving from one asset to another. Converting crypto to Australian currency or foreign currency. So that's the other one too. So if you then decide I'm going to liquidate my crypto and convert it to cash, that's another disposal. Or if you buy goods and services with crypto. So you go and buy, I don't know what, there's some things I think you can buy there now. I'm not sure what they are, but again, if you say I'm going to use my crypto to buy this asset, then by converting that crypto to that asset, that's a disposal for tax purposes as well. The ATO knows that. So the ATO have not struck a deal. The ATO require all exchanges that manage people's crypto, provided it's not in an anonymous wallet, because they don't know about anonymous wallets, but if it's on a CoinSpot or what other ones? I can't remember. Independent Reserve, thank you. Yep. They know that you're doing transactions on it, and they want you to report what those transactions are for the year. Now, some of these reserves and exchanges will actually provide you with a report that you can click on, pay $30 for or something like that, and you get the report, and it actually gives you your report. Otherwise, you can then download the transaction to a CSV, and then there's other software you can use to actually calculate the gains. But the key thing is, crypto is an asset that is accessible. If you're going through an exchange which is in the public domain, then the ATO will know about it, and therefore it's in your interest to make sure you report it. We've had situations with clients in the last couple of years where they might have been early adopters. They've then shifted between currencies quite regularly, and then they've got to the end of the year, and then the crypto market has plunged. We've gone back and said, can you give us a report to show us what your taxable gains were for the 2021 financial year? And even though the value was gone, say an example, 600 down to 150,000, they had 400,000 worth of gains for the year that they had to pay tax on, because they weren't aware that the transactions between currencies was a taxable event.
If the capital gain is in cryptocurrency, how does it then translate into?
If you convert it to dollars. So based on the value of the currency.
Oh, okay.
Yeah, you convert it to Australian dollars to work out what the gain is. Yep. Yep. So it's really important if you've got cryptocurrency. I'm not going to make any further commentary on the value of crypto or not, but if you do have cryptocurrency, it is or NFTs, and you're trading in whatever you're doing in terms of this space, you need to make sure that you're keeping proper documentation for it, and you are aware of what the potential tax consequences are. So even if, you know, this situation again with the clients where they might have had all these wonderful gains, they've then left it in crypto, but then the market has dropped. It doesn't matter whether the market's dropped because you haven't sold to realize. Any drop in the market while you're still holding the asset is not a loss for tax purposes. It's just a revaluation. So you've just got to be very careful that you understand the full tax consequences of what you're doing, because the ATO will be coming after people. I'm not trying to scare people, it's just a reality, because they know that there's been transactions on cryptocurrency because they've been reported that by the different exchanges.
So Shane, it's almost like you've got foreign currency accounts.
Yep.
And your main account's a US dollar account. During the year, you go buy some Swiss francs and buy some yen. By the end of the year, you transfer it all back to your US dollar account. You've actually realised gains and losses.
Correct. Yeah, that's exactly right. So the question or the comment was that same thing that applies with foreign currency. If you move from one currency to another, to another, to another, and then move it back to the original currency, all those different movement of currency between transactions between currencies are taxable events that you need to factor in. Yeah, sure.
Assuming it's under general at the moment.
Gee, that would be. Gee, why would you think that? Yeah. I think substantially. Yeah. Yeah. Look, and again, I'm not going to get into the dynamics of this, but there's anonymous wallets, and then there's the ones that are on the exchanges. I would suggest the ones that are in anonymous wallets, there is very little reporting going on. Yes. But it's something that we have an obligation as tax agent, because we know that it's showing up on the ATO pre-fill reports, that we know that we've got to have those conversations with the clients. So that's crypto, and I'm just conscious of time because we could talk about crypto for a long time. Last thing I'm going to go to very quickly is just about looking at the structures about how you hold the investments. I said before, different classes of investments have different tax consequences, but also how you hold those investments too. So we looked at individuals, we looked at superannuation funds. You can also look at trusts, you can look at companies. There's benefits with trusts that they might give asset protection, which needs to come into it. But then you've got to look at the succession planning, which James touched on, and Sophie commented on as well, about the complication with trusts and making sure they're covered under your will, because they generally aren't covered under your will, and making sure we've got the control tests all put in place. But it's all about having a conversation. You've got money to invest. It might not just be putting your own name, because that might trigger higher tax rates. It's about having that conversation with your advisor to make sure that you're getting the best structure for your circumstances, to make sure we're maximising the tax benefits as well as the investment returns on those investments that you're placing. Because there's some pitfalls of trust, and there's all these other things. Again, I'm not going to go into it. There's stamp duty considerations, there's land tax considerations, there's negative gearing considerations that we need to have. But we still need to look at all. And then there's all these new rules, which I'm definitely not going into today. I'm just flagging to you, and you'll see this in the slides. But the ATO are having have got a draft ruling on how trusts are treated, and that can have some major impacts on investment strategies going forward.
Given any further clarification?
They've given clarification, but they haven't finalised the ruling. So it's not. They've told us how they see it, but it's not finalised yet. So we're still waiting for that. Yeah.
They talked about those things being retrospective.
That's not going to happen. Yeah, the trust changes will not be retrospective now. They've said that they won't be retrospective, but it's about whether they're going to apply for the 2022 financial year or not. That's one of the things we need to contemplate, because it's only draft rulings. This is all about trust changes that are coming on board. Last thing I'll just say, which is really simple with all this, with all these things and with what James presented today, it's all about making sure you get the right people around you to give you the advice that you need. You know, we've got Aintree Group have gone down the path of setting up Aintree Group Legal and Wealth. So we've got that holistic service, so we can look at all aspects of your financial well-being as well, and your personal well-being. So it's really important that you do a financial health check of your circumstances. I was saying to someone just before, one of the key things I think which is really powerful in what James was saying was about the cash flow modelling, the lifetime cash flow. Just to know that, I think, is really important. A lot of people just don't know what their ins and outs are on a daily basis, to know what they're actually saving or what they're spending on a monthly basis. So they've got no perspective what their financial future might look like. So just going down that path as a minimum, I think, is really critical. So you actually can understand personally what your your monthly cash flow looks like, so you can actually make some proper decisions about retiring debt, investments, or when you might retire. So doing a financial health check is really important, and then bringing in all the aspects which we talked about. So looking at estate planning, so the legal side of things, looking at the wealth creation, looking at the tax side, looking at the structuring of your affairs, etc., is really important. So yeah, I just want to reinforce that. Otherwise, and we talked about estate planning before, so I don't need to go through that. And that's pretty much it. I don't want to bombard you, and we've been here for quite a while already. So at the end of the day, it's just a matter of, being on top of your financial affairs. I think that education piece is really critical, no matter what age you are, being informed. And we see a lot, and we try and encourage this with our clients. Being informed is the first step in this. So you know what your position is. So then you can make proper decisions going forward, and the earlier you start, the better. So you're not trying to leave it to the end and you get 60 and thinking, oh no, I've got to start really ramping things up. If you can get into a position where you're aware of things and you can start that process earlier, you're going to be far better off. And then educating children, I think, is really critical with this too. Bringing them in as early as possible so that they're fully aware of it, and then they can make better decisions for themselves, as well as what James said. So that's it. So yeah, I don't want to budge with any more. Thank you everyone for your time today. I hope you've got something out of it. We're definitely keen to start conversations with people if you've got a need in any of these areas. And yeah, really thank you for your time, and hope we can be assistance in the future. So thank you.